Hello everyone, welcome to this ICT course where we will go from being a complete beginner to professional. And for those that aren't complete beginners, you can use this course as a gap filler in your knowledge. These are the 10 things we will go over in the shortest time possible while not leaving any important info behind. So first we will go over fair value gap, second swing high and low, third market structure, fourth liquidity runs, fifth divergence, sixth Judas swing, seventh turtle soup, eighth daily bias, and nine how to actually trade. All of this info you will get in this course. So without wasting any time, let's get started to the first one. So fair value gap, what is it, where do you find it, and why? Fair value gap is a gap between first and third candle on any time frame. Fair value gap is used for entries or targets to take profit. Swing low and high. This is swing high and this is swing low. And how do you know? How do you recognize that? It's again based on three candles. First candle is lower than the second candle, and third is lower than the second candle. Swing high can look like this. This is also swing high. Swing low, same principle. First candle higher than second candle lower than third. This is all you need to know. Swing high and low is good for market structure, which is the next chapter. Market structure. This all is market structure. And market structure is basically showing you where the market is going right now. You need two terms to know: break of structure or market structure shift. Break of structure happens when you have downtrend, then little pullback, and break of the swing low. And this is where you need to know swing low and swing high. This is swing low, this is swing high, swing low, swing high, swing low, swing high. And market structure shift happens when you have basically a reversal in the market. So we have swing low, swing high, swing low, and break of the swing high. Now we are expecting the market to go up. This whole thing works the other way around. So if you would flip it, it would go down. And it's very simple like this. Liquidity runs. You need to know where the liquidity is. So let's say we have this high here. The price goes down from here and breaks this low here. This is liquidity, sell side and buy side. We took out the sell side liquidity, and after that we can see that there is market structure shift, which means for us that we are targeting the buy side liquidity, and this is your target profit. Once again, this works for the other side too. So just so you can see, it's the buy side and sell side. Those are the two types of liquidity. Divergence. This happens between two indices. This is when you should have more charts on your screen than one. So what is divergence? You can see ES made this low, NQ made this low, then NQ broke through that low and took out sell side liquidity, but ES didn't. And what is this good for? This is showing you that ES wants to go up, so you can expect market reversal. And that's all you need to know to divergence. Judas swing. This is what Judas swing looks like. This range can be the Asian range or a range from midnight to 8:30 on the New York time. And this is what is the Judas swing. You will see taken one side, then the other one, and then back to the original side. Judas swing is made to basically stop everyone out and take everything from the market. So what you can be doing is trade this and also try to trade this too. And how can you trade this? By using the market structure shift. So when this low is taken out, you will go to the 1 minute chart, look for market structure shift, and target this liquidity right here. When you see this breaking, same thing. Flip this, market structure shift, and target this liquidity right here. Let's go to the next one. Turtle soup. How to trade with turtle soup? You want to look for relative equal highs or low. Wait for a break of the high. And this is where every retail trader would go long. But you are waiting for the first inefficiency in the market. So that would be break of order block, fair value gap, anything, and you're targeting the low. Again, this works to the other side as well. Daily bias. How to know where the market is going or how to get your bias. It's very simple. It's the same thing like intraday or almost the same thing. Let's say we would not see this price right here. You would just see this big candle and this low right here. So on this candle, my bias would be that we will take out this sell side here. And after that, I would expect it to go higher, or depends how strong the push would be. And that's like, it is very simple. Or you can look here, we have fair value gap. So on this candle right here, and this one, my bias is that we should reach to this fair value gap. So I would be bearish. Right now, we can see that we took out this high, but we also have these candles right here. So right now, it's very hard to say if the price is gonna go up or down. And that's why you cannot always have some bias. You should always go from the week to daily for hour. And that's it. Just look for the same stuff you would look every day. Now the most important part of this course, how to trade ICT concepts, how to take everything together and be profitable. So there are a couple ways you can trade all of these concepts. First, you can you can trade the Judas swing, which as I showed you before, it's this right here. Okay, you can see that we took out this high, this low, break of one side, the other one, and back again. So let's look how it looks in real life trading. We go to the 5-minute chart, or you can also go to the 15-minute chart. Mark out the midnight, then 8:30. It's here. We know that it's here. So find the low of the trench and find the high. After that, go to the 1-minute chart. Wait for break of either side. When you see the break of the side, so we have the break here. You wait for market structure shift. So we see that it broke, no shift, only break of structure. So it's going up, still waiting. And here it happened. Huge candle. You want to see huge candles breaking through fair value gap. Enter on the fair value gap and target the low. This is how Judas swing is traded. And it's also how you can trade anything else through market structure shift. So we can see here the structure shift. We have swing low, swing high, brutal candle, leaving fair value gap behind. Enter on the fair value gap, target the liquidity, and that's it. Now, let's look at trading with divergence. For that, you should make yourself something like this, where you have all three indices, ES, Dow, and NQ. Right here, we can see, for example, this morning. So we have ES, the Dow, and NQ. 9:30. I'm gonna mark it out. Oh, okay, let's see here. So we have 9:30 high. We can see that NQ took out this high. ES also took out this high. but Dow didn't. And this is showing us that the Dow wants to go down, so we should expect some reversal. And this is the only thing. This isn't the only thing that you should look at. You then should wait for the market structure shift or something, at least like a move down, but market structure shift is best. And it's just a confirmation for you. So this is divergence. And now we can look at the last thing, which would be turtle soup. We can see relative equal lows here. Break of the relative equal lows. Some people would think this is the breakout, but this is actually time for you to go long. And as you can see, the price is going up. And this is really everything you need to trade ICT. So if you like this course, leave a like, subscribe, and see you in the next one.